Welcome to our weekly Tim and Veronika market update and mortgage rates and mortgage industry updates. Today we have great news to share about the rates and the course that inflation is taking, or I would rather say inflation is slowing. So I would like to start with Tim sharing his wisdom and news with you. You have the stage.
Thank you, Veronika. It's nice to come on here with a smile on my face instead of saying, you know what, rates, they're higher today than they were a week ago. But we have good news, and I think there's a trend of good news to come. But again, we'll have to see how that all plays out. But basically, the inflation rate is what's driving. The higher the inflation rate is, the higher that it'll push mortgage interest rates. And the information that came out earlier this month was inflation, while it is up from last year, the expectation of how much it increased by was less than what it was. The reality was less than what they forecast, which is always good news. So in other words, inflation was lower than expected. But we talked in previous videos about the Federal Reserve. Now, the Federal Reserve is the branch of the government that tries to keep inflation and employment in check, and promoting employment, keeping inflation low. And so they did raise the prime rate, the rate that you would use when your credit cards or short-term lending like an equity line of credit. They raised it a half a point literally today, but that was less than expected. They were expected to raise it by 0.75. So I think they took the cue from the market that said rates or inflation is slowing. Let's not overdo this and create too much of an increase in rates, because the fear, if that happens, is you would send the economy into a recession. So they're walking a very fine line between tamping down inflation, but also not sending us into recession. So all in all, good news. Rates resulted in about 1/8%, in some cases 1/4% reduction from where we were 2 or 3 days ago. So and the net of it is that you have a better rate today than you did on Monday. That's the bottom line.
So with a 20% down, let's say a conventional loan at 20% down, just as a point of reference, what are we looking at?
Assuming good credit, 6.375, probably 6.25 with maybe a half a point. So we're down from like 6.5 on Monday. This is for us now. I'm speaking just for Security National. Obviously, different lenders have different rates, but certainly we're all heading in the same direction because we're all influenced by the same events. So it's better today than it was then. And again, I'm cautiously optimistic we're heading in this direction, barring any other foreign event that would cause problems with inflation, like supply chain issues. That would mean that we would have China gets shut down where we can't get any materials out of their ports into the United States, which means inflation goes back up again. Those are all things that we can't control, but they seem to be coming back into alignments. There's not that big concern that there's going to be a lot of inflation in our near-term future.
That's great news, Tim. And I would like to add to that decreasing interest rates may also help with the inventory, because currently sellers are keeping their homes. They don't want to sell them. If they need to finance their next purchase, they really don't want to exchange their 3% mortgages to 7%. So this is why we don't have enough inventory. We do have enough buyers. We just still don't have enough homes. So just to give you, in a nutshell, quick update, it is still a very strong sellers market here in Metro Atlanta area. What do you think going to happen next year, assuming no negative influence from?
Right. The general forecast, I've read a lot of the different, the different agencies, Fannie Mae, Freddie Mac, have their forecasts. The federal government has their own forecast. You have to always be careful because certain people, like, for example, Fannie Mae, Freddie Mac, have a a self-interest. They want to have lower interest rates because that means that more people would be obtaining mortgages. But the general consensus is that rates will slowly go down over the period. Maybe they're talking about 5.5% by this time next year. So maybe a 0.75% from where we are today. It's not back to 3%, not back to 4%. But if the new normal is, we're coming down from 6.25, 6 3/8, it's relatively speaking, it's a better deal, obviously. So we're heading in that direction. It's just not going to be an overnight light switch.
Just to put it in perspective, how would you answer a question for the buyer? Should we wait until December next year to buy?
Well, I guess
to get a better rate.
I'm sorry?
To get a better rate.
A couple things. One is that let's assume that values continue to go up. If the seller's market remains for the reasons you just described, that means there's pressure, upward pressure on home prices. So if you wait, the 5.5% may be on a price that's, $50,000 to $75,000 higher than you may have gotten today, number one. Number two, with buying a house, obviously the important thing is the house, the mortgage, as we like to say. You marry the house, you date the mortgage, which means if rates go down, you can be assured that you will, not just from me, but from anybody else that is in the mortgage business, you'll know about it because there will be a massive number of folks that want to refinance out of those higher rates. So to me, if you buy it today at today's home prices, you can avoid having wait a year, your rates are a little bit lower, but the price is up, and you could have gotten that same interest rate 1 year removed from that. Secondarily, we offer what's called a 1 year buy down, which basically means we'll give you a 5.5. We'll pay for the cost of giving you for example, a 5.5% interest rate for the first year, which the permanent rate would be 6.5. So if in fact rates are at 5.5 in December of 2023, you're essentially saying, okay, well, good. I don't have to go back up to the original 6.5% note rate that I got a 1 year reduction on. I could just essentially have the new rate as a permanent rate, the 5.5%. I hope that makes sense. And if it's a little confusing, I'm certainly happy to answer questions if people want to call me.
Yes, Tim, why don't we explain a little bit more? First of all, how long this promotion is going to stay in place?
Well, I was supposed to end. I had it ending at the end of this year. We're going to extend it through at least the first quarter because we're trying to figure out, as rates are this much higher, I think that it'll help push some people into the pool of saying let's not wait for the reasons we just discussed. Prices will be higher, rates may be lower, but the trade-off is not going to be enough to make a difference from where you are today. So for a buy down, what we were offering through the end of the year, which will extend through the 31st of March, is simply that you will get an interest rate that is what we call the note rate. That is the rate you'll have after the first year. Let's just say, for example, using the example, let's say 6.375 is today's rate. If you got a 30-year fix, it would be 6.375 from the day you get it, the first mortgage payment until the 30th year's last payment. We're offering a 1 year buy down, which basically means you'll get a 1% reduction on your interest rate for the first 12 payments. So in this case, it would be 5.375 for the first 12 payments. And then after that, it would go back to the 6.375. You'll qualify at the higher rate, but you'll get the first year's rate as a reduction. That again, if rates are heading in a downward direction, it hopefully will coincide so that when your rate is about to go up, there'll be an opportunity to stay at the lower rate with a very low cost refinance. Maybe it costs you $1,000 to $2,000, but you'll save probably $2,000 to $3,000 a year in interest payments that would go on for the rest of the time you own the home. So that's kind of how I hope that makes sense the way I explained it.
Yes, it does. Thanks. Just essentially, the buy down means somebody's paying for it.
And that's us. Usually it's a seller could pay for it. The buyer can pay for it, which usually isn't the case because the last thing the buyer wants to do is pay all things being equal, they'd rather have somebody else pay for it. Some cases the seller will do that, but in cases where the market is tight, which again, it's still kind of a seller's market, some sellers are willing to pay closing costs. But to kind of take that out of the equation, we're covering the cost of the buy down in the near term. Hopefully a year from now, we'll be laughing about buy downs because they won't be needed anymore because rates will be already down permanently, or at least lower permanently. So that's why there is a cost. We're paying for it, and it's a promotion that we've had some success with. And I think that getting people off the couch and into looking at houses will help. This will help make that rationalization of, let's not wait, let's go ahead and buy now because the prices are lower, and we'll be able to find something that we can get a lower rate at some point in the future, but we'll have 12 months to pay a lower payment until we get that rate.
That's exciting. The other promotion that we were talking about, the 90-day lock, is it how long this one is going to be in effect?
That's not ending. That is, we have a 90-day lock we call Lock&Shop, because we're basically, you don't have to have an address when you lock. We have to have a basic pre-qualification done so that we know that you qualify for the locked rate that we're going to lock you in at. But assuming that we do that, then rates drop during that 90 days. We can lower the rate one time to the market rate at some point before the closing date. So obviously that last 90 days, let's say we lock it, you start looking for a house, you have a contract at 30 days into the thing, so you have another 60 days. And then if the rate drops during that period of time, we can lower the rate to the current, we can lower to the current par rate, let's call it. And the rates will never go up. It's just an opportunity to what we call float down to the lower interest rate. So it's a no-lose situation, but we can't couple that with the buy down. It has to really be kind of one or the other, if you think
really?
about it.
Okay. All right.
Well, yeah, only because the buy down gets complicated in that there's a lot more paperwork with getting the documentation in. So it's kind of, without getting into too much complication, it's something that we have to make sure if we lock the rate for 90 days, the buy down becomes exceptionally expensive at 90 days because the longer you lock, the more expensive it is. I'm happy to pay for a lock on a buy down, but for doing the extended rate lock 90 days plus the buy down is not something that we can couple them together, because that would be something that we couldn't offer together. It's either one or the other, I guess, is the way to look at it. So,
all right, it does make sense. Thank you, Tim. Is there anything else a buyer should know these days?
Well,
hesitate.
yeah, I mean, it's always one of those things where we were talking about, buyers. There's two big things. One is if, somebody's buying a house and they don't have the down payment money, I guess it's always one of those conversations. A lot of times families, parents may give a gift to the child. And that does two things. Obviously, the parents can be on the loan with the child, assuming that they needed that for qualification. And the benefit of that is the son or the daughter gets the home as their primary residence. The parents are borrowers, but the obligation is to be paid for by the child. But the net benefit to them, the child, is usually, if you're starting out life after college, you don't have $25,000 sitting in a bank account typically, or maybe you do, but usually more likely you have $25,000 in student loans that you have to pay than the $25,000 in a bank account. So having the bank of mom and dad, as I like to call it, give you a gift for the down payment is a wonderful thing. But the more important thing, if you needed the additional income, the parents, many parents have helped their child buy that home by being non-occupant co-borrowers. And people have done that for their kids when they went to college, as a matter of fact. And they bought the house as a place for their child to go to college and rent with other roommates. And then once the child left, they had a rental property in a college town, which meant that it was an income producing property that they had, beyond when their child was was in the home themselves. So
just quickly reiterate what you just said. Sometimes parents think that they have to be on the loan as a co-signer, right? When
Yeah,
they
right.
decide to give a gift.
There's two different things here. One is the bigger challenge usually is the funds for down payment, right? Because that usually is a harder thing for especially somebody starting out in life to be able to qualify. In some cases, maybe, let's just say the parents want to have the child on the loan, but they may not have enough income, or maybe like the case if they're going to college, they don't have any income, and so the child is buying the home. In the case of, let's say, I've done a lot of loans for people who went to Georgia, bought a place, the parents bought a place in Athens, and the kid was on the loan for the credit score, but that was it. But it's now their primary residence, which means lower taxation because it's a primary residence. And it becomes the parents, you're also putting 5% down on a property that potentially could become an investment property that could generate income from, after your child, assuming that they move out after they graduate and they aren't living in the Athens, in my example, area, you can rent the place out. And, to me, that's one of the best places to have rental properties in a college town, because we know the parents usually are pretty good about paying those rent payments on time. And as you can be on the loan if it would benefit you, and being the parent, which again, I think of this, I don't want to get too confusing here, but if you're simply helping your child buy the house and they qualify on their own income wise, then giving them a gift is all you need to do.
Does it have to be a relative? And if it does,
absolutely,
how
yes.
wide down the family tree?
Yeah,
do
that's an interesting question. That's an interesting question. FHA allows for what they call basically somebody who's been a friend that can document they've been a friend for like 10 plus years. In other words, it's somebody that didn't just, I don't know how you do that. I have never done it that way, but they allow for non-relatives by blood or marriage to provide gifts, like a lifelong friend or whatever. And I've seen that done, but I have not done it myself. With conventional or other types of loans, it has to be a family relationship, cousin, uncle, sister-in-law, etc. And
a wife, right? Just what we recently had, a wife contributing.
Exactly. No, that's exactly right. Yeah. In fact, in some cases, it's better to have, we're going to get into another area of discussion. It's sometimes better to have the gift funds for the down payment than having to look in somebody's bank statement, because underwriters like to look in bank statements, and if they see something that looks odd, they ask questions about, well, where are you spending this money? I see a $2,000 a month payment each month to whatever, something, but it's I've seen 2 months, 3 months payments. It's $2,000 a month. Do you own another car? What is going on there? So sometimes having gift funds is essentially allows you to say, we're going to put $15,000 down. We're not going to show you any bank statements, and we're just going to have $15,000 wired from the gift donor to the closing attorney, which makes it it's very simple from my perspective, because it simplifies all that looking at, it's like you're looking through.
Plain and simple. True.
Yeah. It creates less reasons for things to go wrong. And that's always the thing you try to avoid, is the unforced errors that cause a very simple, good file to go into a situation where it may not close because there are things on there that are, concerning to the underwriter, and that puts us into a different category of, is the loan going to close or not? So, but
thanks so much, Tim. We appreciate you bringing us good news and some hope.
Well, it's Christmas time. I figured there'd be something, if I should wear the little Santa hat maybe, and just to kind of, say, and now you get a present, and now you get a present. So
some hope and some light, for those who celebrate Hanukkah.
That's true. Hanukkah
that's
too.
exciting.
Right.
Hope and light.
All lights. That's right.
I like that. Well, happy holidays, everybody. Thank you for staying with us. Stay tuned for the next week.